I mean, before that, you had other companies looking at this kind of the arts industry and try to see how they can broaden the scope. So if you look at Masterworks, for instance, where they try to pull together investors so they can buy a painting, and then so you own like a painting, so you don't need to be a billionaire to own a super painting. You can get this exposure. I mean, when you look where we've been in past 10 years, you can really build portfolio of a multimillionaire now with just a fraction of what you used to need. Still, people don't take the opportunity to do it. That's where there is more to do here and say, look, you can get exposure to that. You can get exposure to art, maybe through NFTs. You just need to look at how this fits into your strategy. It's quite interesting the way like tokenized, like the way you can tokenize assets that were before that not really used, or like the value would just sit there, and as an artist you can actually gain much more value now than just waiting for a rich guy to come up and say, oh, I like this painting, I'll put it in my living room, I'll give you like 200K.
Welcome to the Invest Smarter podcast. If you are joining us for the first time, I am so happy to have you here. My goal is to bring valuable, thought-provoking, and insightful conversations and topics to you so you can invest smarter in both your portfolio as well as your life, so you can live an enriching and wealthy life now and in retirement. My guest today is Tristan Pellew. He is passionate about all things fintech and is the creator of FintechReview.net, which is a media website with a mission to demystify all things fintech going on around the globe. Today we get into what fintech really is, some of the biggest themes in fintech, what the established banks are doing to stay relevant, how fintech is changing the investing and wealth management landscape, and more. That's enough of me, so let's get into the interview. I hope you enjoy. This is my conversation with Tristan Pellew. All right, Tristan, welcome to the Invest Smarter podcast. I'm pumped to talk about fintech with you. So just to get on the same page, when we talk about fintech, what exactly are we talking about when we say fintech? Because I've heard that term used to describe pretty much anything with technology. So let's try and narrow down that definition a little bit.
Yeah, sure. Yeah, it's true. Like it's quite the buzzword these days. It's not as buzzworthy as blockchain or cryptocurrency, but fintech is quite high on the list. So, I mean, in simple terms, fintech is just technology applied to finance. So that's why it's quite broad, but you need to have both elements. You need to have technology and you need to have finance. I look at it a bit broader than that. I look at it as innovation in financial services more broadly. So new business models or new ways of doing things more generally. But yeah, I mean, literally, if you were to open a dictionary, financial technology is financial technology. So as you say, a lot of software companies would say, oh yeah, we're in fintech. And I look at it, I'm like, no, you're not. But that's the joy of buzzwords.
So what are some of the categories of fintech, and how has it evolved over the last 15 years? Like, how did fintech start? Because I feel like it's become it's encroaching a lot more now on the consumer side, but maybe it used to be more in the back office or something.
Yeah, I mean, it has always existed in the sense that, an ATM is financial technology, but it has evolved. And I guess, as you say, is that you need to you have infrastructure kind of fintech, so a lot of stuff happening in the back. So banks have been relying on technology since technology has been around. So all the stuff they've been doing to manage your accounts, as soon as they became kind of dematerialized, then you had fintech coming in, and when you are depositing your check and someone was not converting that or putting it in a room behind, actually, oh no, it's happening. It's one and zeros. So this was fintech. But post financial crisis, you got all this consumer focused businesses that popped up, and this is where it became really trendy. Is all the Revolut, the Monzos, the Wise, the Stripe, all this stuff coming, and then you were like, oh wait, fintech exists, but yeah, it's been around for a while.
Yeah, for sure. It's definitely been around, and it seems like there's always something new coming every day. So, what are some of the like main categories of it that exist today, and like some of the biggest companies that maybe people are familiar with, and like and maybe just go into a little bit of like what is it that they are disrupting? Like what are they trying to disrupt or replace or innovate?
Yeah, I guess the first big wave of stuff that happened um, was around payments. So is either business to business payments. So companies like Stripe in the US or Checkout.com out of London. Um, so and then you have like payments as in money transfer. So TransferWise. So now it's Wise, or a number of companies in that space, because it was easy to disrupt. Like banks were terrible at it, so that's why they attacked this thing first, and then they looked at other kind of value chains. So then that's how digital banks came to life. Try to replace the useless customer experience that you used to have with banks, and then kind of looking at businesses, so business loans, business accounts, and then there are a host of things because businesses are complex. So you have invoice finance and asset finance and a lot of stuff. But really what they're disrupting are incumbents, and most of them are banks or wealth managers, or like stuff that like institutions that have been around for a long time have failed to evolve. So people have looked at it and say, oh, you know what? They're not doing things right, so I'll do it better than them.
Yeah. Let's talking about the banks. Like what is the state of the big banks? I mean, clearly they're trying to, jump on late to some of this stuff. At least from my perspective, it seems late. Like there was Venmo, right? And then all of a sudden they come out with their whatever they call it, Zelle, right? And they're trying to like do that, but even Zelle is clunky, and I don't use it. And then I guess they're trying to do more online mobile banking, and so like what's the future look like for banks? Like maybe in 15 years, what do they look like?
Yeah, so I mean, some banks kind of, as you say, they're trying to react. So JP Morgan, they're buying a bunch of companies, they're trying to launch stuff, and then others kind of they've been discarding the threat for years. It's like, oh, who cares? These guys, they're a bunch of nerds in a garage. They're not going to do anything. Then, as these companies grew to be huge, like PayPal, um, oh yeah, it's just to pay on eBay. Oh, actually, it's a bit more than that, and became a big company. So, I guess some banks will kind of disappear in the background and become like kind of infrastructure companies, like energy companies. They're just utilities, and they will stay there because they have big balance sheets that can be used as long as they can gather deposits to be able to lend that balance sheet. So they can stay in the background. They have licenses, are hard to get, so they can kind of survive like far away from the sight of the normal human being. But I think some of them are trying to push back. And yeah, as I said, JP Morgan, Goldman Sachs have moved into consumer finance, and they kind of like to be there, so kind of try to grow. I'm not so sure about others like Wells Fargo or this kind of guys that you don't see them doing a lot of things to fight back the threat. So God knows what happens to them in a few years.
So it sounds like you think JP Morgan might be better positioned to be more relevant. And so which banks do you think are doing the better job at being more relevant? And which banks do you think are being left behind? You mentioned like Wells Fargo, perhaps, but what do you think?
Yeah, I mean, it's hard when you work for. I mean, I used to work for an incumbent bank in London, Virgin Money, and it's hard when you're a big institution to try to move and do stuff differently or innovate. It's quite difficult because you're a big beast, so like try to move. So yeah, I think JP Morgan, they've been taking the views that, okay, we can't really change the way we do things or can't innovate, so we'll buy a bunch of stuff and we'll see what happens. I think some try to reposition themselves or focus on certain things. So Citi, HSBC, to some extent, they're like, okay, well, let's focus on Asia, like let's do that. So some banks have decided to refocus a bit their attention on certain stuff just to be sure that they don't get it wrong, and others are a bit like I mean, there can be a view as well if you're Wells Fargo, for instance, is dealing with lots of problems that they've had before, so that's probably what is top of their mind rather than, oh, Venmo has launched this new feature, and they probably think they can outlive some of them or most of them, which is in some sense true. Not all fintechs will survive, and maybe you're like, I have a sustainable business model, get some profit, we should be fine. We survived 150 years, we'll survive the next 150, which is true, maybe, or maybe wrong.
Yeah, I have Wells Fargo. I use it. I feel less and less tied to them. I can't tell you the last time I went into a branch. And I'm probably just one more ounce of frustration away from just switching to something that's more intuitive and just more easy for me to use. So I definitely view that as a risk for all of those banks, and they have all that property in those branches that are, I feel like they might just end up being just vacant buildings at some point. Like, do you think there's going to be closings of those if they can at least maybe sell them or get them off their balance sheet at a decent price?
Yeah, in the US, it's a bit behind in that respect to like other countries. Like in the UK, past 10 years has been brutal in terms of branches closing down, and the US and other countries like France still have a high ratio of branches per capita. But if you look 5 years, 10 years down the line, you won't have that many branches because, as you say, people don't go to them. I've been doing this. It was my job, closing branches or deciding at least the ones that were going to close. And we had some branches where they wouldn't see a customer in a day, or they would see one or two. And you're like, why do we have 4 or 5 guys or more just twisted their thumbs and just waiting for someone to pop up? So I think there will be a change in the sense that some banks have tried to reinvent the model. So what do we do actually in a branch, and trying to change it into like cafes or like more community places, because it's true, it used to be like center of the community, go see your branch manager, and this is where you meet other people in town. Now it's not, but so maybe there are two ways. Either you try to reinvent the model of what you do in a branch, or you close it down and you just move on and there will be a new business. But for banks that have large networks, it's quite complicated. It doesn't happen overnight to say, I'm going to close 1,000 branches. It takes time. You have leases. You have so many headaches to decide whether or not you want to do it.
Yeah, and you're talking about them being big behemoths that's slow to move. I mean, so you have a branch with 4 people there and no one's coming in every day. Meanwhile, all those resources you're spending on paying those people, another startup is using resources much more efficiently to compete against you in the future. So it's definitely harder to move, I guess, when you're that big, and some of that is just unavoidable.
Yeah, no, definitely. And as you say, what you were mentioning about your Wells Fargo account is that there's less and less stickiness. It's not the same as it used to be, where you bank with your bank forever because your parents were banking with that bank. And this is the things you do. Now it's changing, and the more you use other services, the more this stickiness is going away. There is this underlying risk, which is you keep your Wells Fargo account, but you use whatever, you use Venmo, you use this money transfer, you use whatever, and then you're at one point you're like, hey, why am I keeping this account? It's useless, and zoom. So it's happening over time, and it's an underlying risk in many of these banks, as people are used to use other services.
I'm exactly at that point right now where the only way I use my Wells Fargo account is to have my pay deposited there, and then every other sort of service I use will be outside of Wells Fargo, something more intuitive. So 100% I agree with you that that's an underlying risk. So moving on a little bit, when I was doing some light research on this fintech stuff, there's a lot of stuff that I just don't really understand or haven't been following, like embedded finance or decentralized finance or open banking, or how is AI changing the way financial services works. So let's try and shed some light on what those are at a high level. Like, what is embedded finance?
Yeah, I think so. Embedded finance is, the way it sounds is that you try to embed finance much more in the customer journey, so that it becomes quite invisible. And it's a bit like, the best example is the way Amazon has done over time, which is, you don't see even the payment, you just like, check out whatever, or Uber. You take a Uber, like, it's seamless. The idea is that most financial products are just enabler of experiences, is that you actually don't care about what you use. So you don't care about the credit card or the mortgage. The enabler of doing something else. You want a house, you want a mortgage, like, so that's a way to try to integrate these things much more into the customer journey, where it just becomes in the background something you don't have to worry about, because actually in reality people don't care. So as long as it's happening and it's not a hassle, and it's not a separate customer journey where, oh, I want to buy a house, cool. Now I'm gonna go and check for the mortgages and whatever, and then I'm gonna compare the mortgages, and well, okay, what if I can do all this in one go, and actually it's just going through. So maybe mortgage is a bit too big, but whatever, like buying a car or buying something on the internet, like, and you split three times with Klarna, like this kind of stuff. It's embedded finance.
Okay, that makes some sense. So Uber is not a fintech company, but let's say they probably use fintech services behind the scenes, embedding it in their service. Is that kind of on the right path?
Yeah, I think if I'm not mistaken, I think they use Stripe, which is a big payment company. But yeah, that's also one thing with embedded finance, is that it's embedded into the actual like customer journey, rather than starting at the fintech side. Is starting at the business that has an interaction with the customer.
Yes. Okay. That makes sense. I just learned what embedded finance is, so thank you for that. Now moving to decentralized finance, what is that, and is that related to blockchain?
Yes. So decentralized finance is, as it sounds, trying to reinvent a bit the way the banking system works, in the sense that usually a bank, what they do is that they take deposit from you, from me, and then they go and they lend it to Bob and Joe and Martha, because they need money, and you have excess money, so you give it to them. They do this matchmaking. The idea with decentralized finance is that the matchmaking is done by like software. So you and I, we put money into like a pool of deposits, and then automatically you kind of, it's dispatched to people who actually need the money. So the idea is, instead of having a centralized system where a bank or whatever intermediary is in the middle, you just have a piece of software that will decide where it's best, depending on the interest rates and who needs what. So that's the idea of decentralized finance, and using blockchain technology through like crypto tokens and that kind of stuff. But the idea is always the same: is that you're trying to match people that have excess cash to people that need cash, but you try to automate it. But it's not, and it's not as simple. The Congress is kind of grappling, not grappling, but they're trying to wonder, who's responsible in this model, because before you can turn to the bank and say, what have you done? And now you're like, oh, okay, well, who do I turn to if you and we put money is lost? Okay, yeah, but I thought I was this was secure, but it's not secure. So it's breaking down so many established things in finance that it will need a bit of time to decide exactly how it's going to work and who's responsible and what securities are in place and all that stuff.
Okay, well, I'm still a little confused by it. Decentralized finance. You're saying that you take out like a human intermediary who decides how to allocate money from a pool of money, so it would just be more automated?
Yeah, and I mean, you wouldn't even have a real human intermediary. What you take off is really the entity in the middle. So you take off the bank, and basically you're trying to match like different pools, like without anybody in the middle. Human entity. There will be a software, but the idea is that it's distributed so that it's not the responsibility of anybody. Like it's a responsibility of everybody involved. But that's why, I mean, it's a bit complicated, and I'm still learning a bunch of stuff. And I think everybody is trying to understand exactly what are the ramifications. So it's normal to be confused. I'm still sometimes a bit confused when I see like some nuances around these models.
Okay, well then I'm gonna be perfectly okay with being confused. But it's something that I'm sure we'll be hearing more about in the future. I was reading something. Is there a company that's trying to make like credit scores obsolete and trying to change the way that we consider who is creditworthy?
Yeah, I mean, it's true. Like the way lending works is a bit integrated with the credit score, and it's quite rigid. And you either fit in the box or you don't fit in the box. And if you don't fit in the box, then too bad. So I don't have a specific company in mind, but there are various ways to try to look at other data points to try to see if someone is creditworthy, and that's where really the innovation should go. Because with technology, you could think that, okay, well, what if you look at the way I'm interacting with my bank account, and you can see I have money and money is flowing, even though I don't know, I'm self-employed, I'm an entrepreneur, but you can see that actually I have money. So there are ways you could try to leverage technology and other data points to try to see if someone is creditworthy. But I think when you have companies like Oak North, they're in the US as well. They're working with several banks. They're like this kind of infrastructure fintech, and they use their AI platform to analyze a lot of data to decide like more accurately what the interest rates should be for customers. Not sure is actually looking at on the individual side to see, oh, you're creditworthy because of this data, but they're more looking at, this is all our history of data. Let's analyze it and see if this was a good idea to give you like this loan, actually even your credit score, blah blah. So looking at all that. But yeah, I mean, this should be, I wish there will be like a word in a few years, maybe not a few years, but 10 years, 20 years, where credit score are relevant, and it's more, okay, I'm looking into you, actually it's fine. Or oh no, I'm looking into you. You could have a good credit score, but actually you're too risky.
Mhm. Yeah, that'll be interesting to see how it goes. I found that article I was reading. The company is called Upstart, which I don't know if you've heard of. I haven't really heard of it, but yeah, it says they're looking for, just like you were saying, to use different data sets to determine credit worthiness, like employment history, education, and whether a would-be borrower knows their credit score, whether a would-be borrower just knows their score. That's interesting. Shows that they're in tune with their situation. Talking about the industry that I'm in, which is wealth management, we've certainly seen some, I guess, fintech, right, where they're trying to help people manage their money themselves using technology. And I was wondering if you have any thoughts on the landscape there and maybe some of the more exciting things that are coming down the pipe from there.
Yes, I think it's it's a part of fintech that is quite interesting. I think there's been a lot of stuff being done around investing. So democratize the way you can invest. So the infamous Robinhood, and it's quite easy these days to invest into anything and everything. Really, when you look, maybe 20 years ago, it wasn't so easy to be so diversified, and now you can buy an ETF on absolutely anything, and it's quite cheap to get diversified, and you can even invest into private companies like startups through crowdfunding and stuff. So there's been a lot of innovation in that space, and it's been quite exciting. I think where I'm still looking to see some really progress being made is trying to help people actually make the right financial decisions. So more on the planning side than on the investing. So because a lot of people, I feel, are not taking the right decisions, and it's maybe because you can do everything and anything, but for your wealth, it's probably not great to trade everyday options on Robinhood, because chances are it's not going to turn well. So I would be quite interested to see what happens more in that space.
Yeah, that's interesting. I totally agree with you. You're preaching to the choir when it comes to some of the downsides of, Robinhood's, whole mission of democratizing the markets. They've also democratized access to doing it the wrong way for a lot of people. When they throw confetti down when you make a trade and stuff like that. So there's certainly been some detriments, but then again, a lot of the new investors that have come into the market, especially since COVID, probably will evolve and realize that this is really, like, I'm not doing this right. I need to evolve and become more sophisticated, and other people will get, washed out, and they'll have to try and live to fight another day, I guess. But I see a lot of the technology on the planning side is not really, it's not even available really for the average consumer. Like, we use, planning software, right? But we control it. So that is interesting to wait to see what they can come up with to help people make decisions, because I wanted to ask you, I feel like there's so many options and so many things you can do now that, like, are we at risk of just over confusing people?
Yeah, no. So I agree what you're saying, but Robinhood is that the thing is, in a bull market, everybody is a genius, because everybody's buying stuff, it goes up, but went up for everybody. So if you had bought stocks, crypto a year and a half ago, well, you're fine. I think we'll see what happens in actual crash and bear market, because it will eventually happen. You look, everything is through the roof, so eventually it will come down. I think, yeah, we'll see how all these new investors react, and it will be a tough lesson for many. But yeah, no, I'm really interested in that space, and I'm I'm building a startup in that space, like around trying to help people make better financial decisions. But it's quite, as you say, it's quite tough because you can do so many things and do it in so many different ways. But at the same time, it needs to be a mix of guiding and educating around, okay, you should do that, like around diversification, because the way I see that there is a huge lack in terms of basics of this is what you should be doing. I mean, okay, it's boring to buy an ETF on the S&P 500, but it's good for your retirement. So, you should put a bit. Or, what is your time horizon for your money? Well, if you want to cash out in a year, don't invest into equity because, of course, it's going up now, but it fluctuates a lot. So there are lots of basics that are missed a bit into all the confusion on, like, influencers on Instagram and TikTokers and cryptomaniacs, and it's a very confusing time if you want to invest. And a lot of the people ask me because oh, Tristan, you work in finance, what should I do? Is my money where should I, what should I, oh, I've seen this guy, he said that, and like, should I buy Bitcoin, which is the question I'm getting the most. And it's a very confusing time, too much information available.
Yeah, so much information available, and getting asked questions like, should I buy Bitcoin? I just usually say, maybe with your gambling money. But besides that, like, I don't know. And I'm not going to tell you to do that because no one really knows what's going to happen on that front. Right. So what are we going to do? Like, there's no way you should be putting a lot of money into that, especially what you can't afford to lose. And then, so you said you were working on something that's interesting, and it got me thinking about like that company Acorns, right? So that is at least good in the sense that it's so limiting in what you can do that you can't really do anything stupid, because you can only do what's healthy for your retirement. But in the silo of investing, it doesn't take into account what is your insurance coverage, what is your, what is all the other aspects of your financial situation, how much debt do you have, like how should you actually allocate the money that you're putting in this account. So are you potentially working on something that does more than just that, something that's actually helps you allocate your resources efficiently, that's most beneficial for your future?
Yeah, so that's why, I mean, I'm attacking quite a complex machine, because as you say, that if you want a holistic picture of someone, then you need to look at everything from assets, liabilities, insurance, tax. Like, becomes very complicated. But yeah, the idea is to try to build a holistic view, like a nice dashboard where give me some numbers and I'll tell you, well, actually, you're probably not allocating right. What are your financial goals as well? Oh, you want to retire in 10 years? Well, actually, like, you're not going to be able to, given what you're doing now. So the idea is to build a tool to help you make better decisions, but not making the decisions for you. You're still very, very, very clear that it's your choice, but at the same time trying to have a bit of a guide where should I invest in Bitcoin? Fine. What's the rest of your portfolio? Okay, well, if you don't have equity for the long term, if you're not looking to buy into real estate and blah blah, then okay, don't do it. Kind of this kind of, so being able to guide people in the decisions they're making, and it's not, and all comes down a lot to portfolio allocation and diversification, then trying to layer other stuff, as you say, insurance and taxes, but it's going to take a bit of time to develop that, because so like specific depending on where you live, and even within the same country it can vary a lot. But I like the space because I feel so many people are confused, And this is where I think there is a bit of a gap in terms of values that companies are offering. Robinhood, they don't care about your financial futures. They just want you to trade. And
Right, exactly.
I actually don't like. I mean, for me, it's against. We want to democratize finance. We don't care if it's good for you or not. It's not our problem. It's not our values. And I'm like, well, okay, I want to build something where my values are. I want to help you, and you make better financial decisions. You know, I'm not a charity. Like, I help you. You pay me. We're all good. But it's not. I'm not trying to milk you until you've gambled all your money, and then I'm like, well, too bad. Fine.
Yeah, I mean, that sounds like a really cool project you're working on there. And if you execute on that, that sounds like a lot of development work. But that sounds like a good challenge. Because even the software that like we would use to help make decisions, it's intuitive to a point, but it still requires a lot of tweaking and human sort of input. So that sounds really cool. And there's a reason why financial advisors and wealth managers haven't been all that disrupted from technology, because at the end of the day, people still need help with their finances. So if you're able to come up with something that actually truly competes with people like me, then that could be really cool for you.
Yeah, I mean, I think as you say, I think there is value in trying to take away as much of the input, like the human input, because people will not put the right, like, professionals would. But if you give someone, okay, here is a model, just put whatever you want, like the interest rates and the average return you want over 10 years or whatever, then people put like whatever. Oh yeah, well, I think I'll do 15%. Whereas if you actually calculate and you're like, well, actually, dude, you're gonna make like 3% at best. So yeah, and this is where trying to take data from as many places as possible, build like a model around that. This is where you can add value, is like, trying to simplify the picture and not let people mess around with the numbers, because you and I, we know, you can make the numbers as you want. Like, it's just the assumption. So I can play around with the numbers, and you tell me it should be 10,000, fine. Like, yeah, okay, fine, it's 10,000.
Yeah, when we make a financial plan for someone, it's a big no to ever tweak the assumed return, because that's cheating. You have to work conservatively and you have to be realistic. So if you're giving someone the ability to say, oh, I want to earn 10% a year, then look, I'm going to retire in 5 years. Well, that's just not going to happen. You have to work conservatively. Like we like to make planned for almost like the worst case. If we can make a worst case scenario plan work, then there's tons of upside to that plan, but but you can't, you have to be conservative. So yeah, I hear you on that for sure. So do you think, obviously, I mean, I already know the answer to the question, but there's clearly room for, advisors and the professionals to live alongside, the technology. And, we can use the technology as well to continue to help guide people and help make better and more informed decisions for like our clients.
Yeah, I mean, like, if you look over since since the beginning of time, people see technology as being, all doom and gloom. But what has happened is that it's more augmenting people than placing them, and creating new jobs and new avenues of growth. And when it's just about, like, adding more value to your clients. And I don't think it's ever replacing or displacing. It's learning how to to work with the technology. this is where people get displaced, is that when they reject whatever evolution is happening in their industry rather than trying to understand, working with it. You see in so many industries where technology has come and it has created so many opportunities. Look at real estate and stuff that are happening really, really great. That virtual visits and those that were not possible like 10 years ago, and now you have like software that can map like really nicely flat, and you can visit it virtually and possibly like buying it remotely. So it doesn't replace the real estate agent. Is that they can use this to get to more customers, to like do pre-visits so they gain time. So there are always ways to look at a new technology in your industry and look at it and be like, okay, actually I can use that and I can save time, save money, and I can, or it helps me maybe look at customers like that were not economically viable for me, but now if I automate this, then actually I can talk to this customer. Before it wasn't possible for me because I was spending too much time. Now actually I can talk to this customer and I can focus my attention on this more valuable customer. So that's the way I look at it.
Yeah, I totally agree. That's a really good point. Being able to adapt and evolve and offer more services and use technology to make for us, for instance, client experience more, more smooth and more, maybe even fun in some instances, especially. And also I think there's an opportunity for education and to just show what's out there. So, people like me can be a resource to clients, just to help them understand like what is out there for them and how it could fit in for them. Because there's so much going on right now. It's crazy. And that got me thinking about I keep seeing all of these new ways. I can't think of any of the names off the top of my head, but where you can like invest in like cards or, art, or you can buy like a piece of an artwork or something like that, or,
NFTs.
Right. NFTs. So that's interesting too, because now it opens up, I mean, you can talk about this, but it opens up, different opportunities for diversification even and over someone's, entire, assets and liabilities landscape.
Yeah, I think it's an interesting space, and we'll see how it evolves. I actually, so on my blog Fintech Review, I published an article about it yesterday around ticketing. So the tickets in if you go to a concert or whatever, and transforming the ticket into an NFT. So it's quite an interesting space, as you say. It could be like providing diversification. I mean, before that, you had other companies looking at this kind of the arts industry and try to see how they can broaden the scope. So if you look at Masterworks, for instance, where they try to pull together investors so they can buy a painting, and then so you own like a painting, so you don't need to be a billionaire to own a superb painting. You can get this exposure. So there are a few innovations around that space where it's gonna, as I said, I mean, when you look where we've been in the past 10 years, you can really build a portfolio of a multimillionaire now with just like just a fraction of what you used to need 10 years ago. Still, people don't take the opportunity to do it. That's where I feel like there's more to do here, and say, look, you can get exposure to that. You can get exposure to art, maybe through NFTs, maybe through investing into like a fund that invests into arts. So you just need to look at how this fits into your strategy. But that's why, I mean, I think it's quite interesting the way like tokenized, like the way you can tokenize assets that were before that not really used, or like the value would just sit there and as an artist. you can actually gain much more value now than just waiting for a rich guy to come up and say, oh, I like this painting, I'll put it in my living room, I'll give you like 200K or something.
Yeah, that's a really good point you make about sort of opening up the world of luxuries that the billionaires and multimillionaires are usually doing, and now the average guy can get a piece of that. I wonder how the billionaires feel about that. It's not as exclusive to them anymore. But yeah, that's a very interesting point. And yeah, Masterworks is what I was thinking of, I think. So thanks for reminding me on that. Yeah, that's really cool. So you mentioned your website, Fintech Review. Why don't you I was looking through it. There's some really interesting articles in there. Why don't you before we wrap up here, just pitch that?
Yeah, sure. So I started it early last year because I was working in London, working for a bank. I was kind of Mr. Fintech within bank, and I was writing articles and reports about what's going on. Then I felt, oh, you know what? I should start a blog and spread my thoughts more widely. So started that. Then it evolved into being more like a small media. So I started doing interviews of business leaders and welcoming guest posts as well. So the one on NFT yesterday is a guest post. So it's been good, like to interact with people in the industry. I still write articles as well. I have a weekly newsletter also where I rant about like what's been going on in fintech and what my thoughts are about. So it's been a good way for me to keep in touch with what's going on and to like get another. I mean, I was very interested in fintech before, but now I've gone in even deeper into what's going on, and this is where I actually saw, oh, okay, I feel like this segment of the market is not covered, and there's an opportunity here. So that's why now I'm working on my own startup.
Awesome. Yeah, the startup idea you were talking about sounds really, really cool. So I would like to be kept up to date on that if possible. But awesome. So I think that's about all the time we got for today. So I just wanted to say thank you, Tristan, for coming on the show. I thought that was really good. I learned a lot, so I think the audience probably was able to as well.
Yeah, thanks for having me, David. I enjoyed the chat. I mean, as you can see, I can talk a lot about this, so it's good that you just cut it a bit, because otherwise we're here until tomorrow.
Exactly. Yeah. I got a hard stop, so I gotta go. But I mean, we definitely could have kept going. There's a lot to talk about, and I'd love to have you back on at a later time. So thanks again for coming on, and look forward to keeping up with you.
Yeah, sure. I'll keep you updated on how I'm doing with my new startup.
All right. See ya.
Email us at investsmarterpod@gmail.com with questions to be highlighted on the show. Thanks for listening, and keep investing smarter.